With that, I will turn it over to David. David is the president of International Collectors Associates. I'm the chairman of the board. David is my son. You probably gathered that. Unfortunately, he got all the looks and the brains, so I don't know where we go with that. But David's going to speak to you about some fairly interesting things. So, David, go for it.
Thank you. There are monumental changes that are coming for Americans, and to review what we've had over the last several centuries, a huge economic and financial power shift is currently underway. If you look back, the 19th century was England's. They controlled the seas, they controlled 75% of the world's landmass, and their currency was king, absolutely. The 20th century was America's century. Following 1944 and the Bretton Woods Agreement, our currency became king. And we have had an empire that's not necessarily one of control. It hasn't been like the British Empire in that regard, but it has been one of influence. And that influence is what we see waning even now as we speak. The 21st century will be Asia's century, and we're already seeing not only the gold move in the direction of China, which is typically the precursor to a major power shift, both economic and political, but we're also seeing a growing middle class, and they're building an infrastructure like we built an infrastructure through two world wars, World War I and World War II. We are building that for them and setting them on their way to success.
Free spending by Americans will slow down dramatically or stop. Americans will have to curtail their borrowing.
Americans will be forced to live frugally for the first time perhaps ever, or at least for this generation, the first time ever. Employment will change dramatically. Millions of retirees and senior citizens will have to go back to work, either part-time or full-time, to survive. Americans will come to understand that our nation is maxed out, spent up, and no longer rich and prosperous. And this is hard from an emotional and psychological standpoint to see America be a fraction of its former self, but that is a reality. America will no longer be recognized as the world leader or superpower. And again, from an economic as well as a political standpoint, we are losing influence, the influence that we've had since the end of World War II. The American dollar may lose its reserve currency status, and this is in large part what gave us our great success, our great influence and power around the world. And as we now have an alternative through the euro and the ire of the world against us, we think the motivation to move out of dollars and into foreign currencies, including the euro, has never been greater. And last, we see the American middle class about to be impoverished, especially as their retirement assets continue to dwindle via market fluctuations and inflation. The two assets that the American middle class holds most dear is their own home and their retirement funds. The retirement funds took a major hit in 2001, and we think that may continue, and certainly with the ravages of inflation is inevitable. But also we see that happening. Their second greatest asset, or perhaps their first, their own home, is now in decline as well. Let's look at the credit meltdown and what is currently happening both in the banking arena, in the real estate arena, and we'll cover this in perhaps more detail than you can absorb in one sitting. Feel free to write down any questions, and we'll cover those questions in detail during the question and answer following our formal remarks. As an overview, the greatest financial crisis since 1929 and perhaps in all of world history continued to snowball out of control in late 2007 and early 2008. It began 6 years ago with low-income Americans being encouraged to borrow on mortgages they could not afford to the tune of trillions of dollars.
So this was the greatest residential real estate bubble in the world, speculative mania which quickly expanded all over the world, and we'll explain how that happened. Trillions of dollars of shaky mortgages were securitized by Wall Street and sold to banks, hedge funds, insurance companies, and pension funds and investors all over the world. The process of securitization is very simple. You take individual mortgages, bundle them together in groups of 50 to 100 or more, and then put them into a format which investors and pension funds can buy on a contract basis or on a negotiated basis. Many of them do not trade over the counter, as it were. These trillions were in turn multiplied into hundreds of trillions in global derivatives, which created the two most gargantuan financial bubbles in U.S. or world history, one in housing and the second in credit. Both of these bubbles have now burst, setting the stage for the greatest financial earthquake in U.S. or world history, possibly in 2008 or 2009. The powers that be, i.e. the Fed, the U.S. government, major central banks around the world, and Wall Street, are massively panicking behind the scenes. Major financial institutions such as Citigroup, the world's largest bank, Merrill Lynch, UBS, Lehman Brothers, and dozens of other large commercial and investment banks are also in serious trouble. A multi-trillion-dollar bailout of the whole world financial system is being engineered behind the scenes to save the big banks and Wall Street brokerage firms. The public, again, may as well be damned, but the big guys must be saved. Just one measure of the incredible magnitude of this crisis should take your breath away. A year ago, total derivatives outstanding totaled $400 trillion, up from 10 to 30 trillion in the early 1990s. At year-end 2007, total global derivatives stood at $681 trillion, up 143 trillion in the last quarter of 2007 alone, up 281 trillion or 68% in 1 year. The system is out of control. The question to ask yourself as we proceed through the evening: am I adequately prepared for the financial Armageddon which is coming? And if not, why not? How do I prepare? Let's look at the anatomy of the subprime mortgage meltdown. Bill Gross said recently, "We haven't faced a downturn like this since the Great Depression." Ludwig von Mises, "There is no means of avoiding the final collapse of a boom brought about by credit or debt expansion." The best way to destroy the capitalist system, says Vladimir Lenin, is to debase the currency. It all started in the mid-1990s when Alan Greenspan, the Fed, and Wall Street teamed up to create the multi-trillion-dollar U.S. stock market bubble, pumping in trillions of dollars in liquidity in the U.S. financial system. That bubble burst, as all financial bubbles do, in March of 2000. And over the next 30 months, stocks imploded, erasing $8 trillion of wealth and almost half the retirement portfolios of 65 million American households. So then, beginning in 2001, the Greenspan Fed began to drive interest rates into the ground and open the floodgates of money creation, flooding the system with trillions of dollars of additional liquidity. These actions over the next 24 months ignited two new bubbles: the U.S. residential real estate bubble and the global credit bubble, which within a few more years, by 2005, 2006, morphed into the biggest credit bubble in world history. Within 5 years, the U.S. residential mortgage debt tripled from $4 trillion to $12 trillion, 11.5, just under $12 trillion. A multi-trillion-dollar plethora of securitized leveraged debt obligations spewed from Wall Street and found their way into stock, bond, insurance company, hedge fund, pension fund, and other retirement portfolios literally all over the world. Wall Street's highly leveraged creative financing. During this 5-year period, the global derivatives pyramid, which is highly leveraged with bets as much as 100 to 1 up to 1,000 to 1 on the future direction of interest rates, currencies, debt markets, etc., exploded nearly 700% from $100 trillion to just under $700 trillion today. Wall Street went into a feeding frenzy of securitizing mortgage debt and issuing trillions of dollars of highly leveraged, very creative, and incredibly complex new debt obligations. These included SIVs, structured investment vehicles. These are structured credit derivatives, bundles of 1 to 30 billion in size. Currently, there's about 300 billion outstanding. Collateralized debt obligations, CDOs, an asset-backed security and structured derivative product. Essentially, these are loans repackaged as securities. There's $2 trillion of outstanding CDOs, and these have been highly profitable for Wall Street. Now, there's different types of CDOs. There's collateralized loan obligations, structured finance CDOs, commercial real estate CDOs, collateralized bond obligations, CDOs backed by groups of other CDOs, or CDOs squared, as they're called. Now, the granddaddy of them all was the credit default swap, or CDS. These